Hello and welcome to Crypto Weeklies. In this video, we are going to analyze Bitcoin and ETH. None of the content is financial advice. Right now, the price of ETH is at around $3,200. The price of BTC is at around 96.6K. It's well below the 20-week simple moving average, which are at around and 21-week exponential moving average. The 20-week simple moving at around 113K. The 21-week exponential at around 109K. The 50-week simple moving average is at around 103K. So prices are below all of these three averages for Bitcoin. And also, if you go back to ETH, you would find that while Bitcoin is below the 50-week simple moving average for ETH, the prices are still above the 50-week, which is at around 3,140. So if something does not change really soon to the upside, there is a high likelihood that ETH goes below the 3,140 level. Again, when Bitcoin falls below its 50-week simple moving average, ETH is more likely than not to follow BTC in that trajectory. Again, none of the content financial advice. Coming back to the ETH BTC 20-week simple moving average price based risk. Again, both ETH and BTC are below 20-week simple moving average. The 20-week simple moving average price for ETH is at around 4K, roughly speaking, $3,980 to be precise. This is the dashboard on Crypto Weekly's website under SMA risk. All the content over here available for free, daily updated, no signups. So this what does this model do? It's analyzes Bitcoin and ETH on their 20-week simple moving average, how the price is doing with respect to that 20-week moving average, and the risk is calculated as difference between the 20-week SMA and normalized by the range of differences observed since 2018. That means not just the raw value between the price, but also proportional and time adjusted difference to account for volatility. And the normalized ranges are between 0, which is the lowest risk. That means price has cooled off so much that the risk is close to 0. Again, risks are never 0, but again rounded off to 0. And highest risk, that means 100% or closer to top, to help provide a comparative view of market volatility for both of the cryptocurrencies. Together, Bitcoin and ETH are somewhere between 70 to 80% of the market share. You can check that out on charts such as or websites such as CoinMarketCap, where they publish what's the current ongoing Bitcoin dominance or Bitcoin market share in the asset class versus what's the ETH's market share. This analytics, you can check it under their dashboard section under dominance. Again, it's just Bitcoin dominance. It says Bitcoin dominance, but it also includes Bitcoin plus ETH. So roughly speaking, Bitcoin is at around 60% of the market share of the entire asset class, whereas ETH is roughly 10%. So accounting for this, to rounding it off, so 10 plus 60 is at around 70% market share for both the crypto. So it makes sense to know what more than two-third of the asset class is doing. Together they are more than two-third of the asset class, so makes sense what they are doing, and analyzing that part is more critical. So this is the indicator that does that in terms of what their normalized risk is between 0 and 1. And again, and during different types different phases of the asset class, it could mean different things. So for example, in 2021, when the risk for BTC cooled off in June 2021, if you go back to the chart of BTC over here, it could mean that in the middle or somewhere over here, in the middle of the rally, again that there was a cool off and the price did come close to the 50-week simple moving average, but again it held it as support, and then the rally continued. Whereas in late December 2021 and mid June 2022 as well, when the risk kind of cooled off over here. The first iteration, again Jan 2022, when the bull market was over, and also in June 2022, when again the first major bearish drop for BTC and for ETH occurred. That meant that at that time period, again, and as the price went significantly below the 20-week simple moving average again over here, June 2022 over here, where the difference between the price and the 20-week simple moving average, the 20-week simple moving average back then was at around 35k. The price was almost 20,000, and in terms of proportion, more than 50% down from the 20-week simple moving average. That ushered in a different kind of accumulation zone for the asset class when the risks kind of cooled off. But nonetheless, accumulating over here when the price was in the midst of a rally and then cooled off, again not the worst idea. What followed was this rally, and again accumulating over here with couple of years, again outlook of more than couple of years, to finally again accumulate at some of the range lows. Again, not the worst idea. Similar story over here in September 2024 as well as in April 2025. If you go September 2024 and analyze what happened over August September time period, price came close to the 50-week simple moving average and also well below the 20-week simple moving averages. In terms of the raw values also, and also in terms of proportion, the risk was low. At that time, the 20-week simple moving average in August and September of 2024, we are talking somewhere over here, September 2024. Let's take September as an example. September 2024, the price was close to 50, between 52k and 55k, whereas the 20-week simple moving average was at around 63k. That again established a zone where the price was significantly lower than the 20-week simple moving average, and also very close to the 50-week simple moving average. That again accumulating at that phase with the benefit of hindsight was not the worst idea. Again, these models are live models and they are not like retroactively fitted to account for what the price action did in the future, to kind of base whether that decision was good or bad. This just compares the price and the 20-week simple moving average. So no benefit of hindsight over there. This model again accumulating at that point would have meant that if there is a rally like we visited from 50k to all the way to about 108k, so 2x rally, that could that could have been a good accumulation zone before the rally. And again, similar story in March, April 2025. Let's take April 2025 as an example, where Bitcoin and ETH both on the risk pair were in the low risk zone. In March, April 2025 over here, price again came cratering down close to the 20-week simple moving average, and again 50-week simple moving average, very very far from the 20-week. Back then the 20-week was at around 93k. The price came crashing to 76k, and then again one leg more up to the upside from 76k to 125k, so little under 2x. Right now what is different is the price is lower than the 50-week simple moving average, and all of these averages are curling down. So in the previous instances, the 50-week simple moving averages were curling to the upside. Now you can see that the 50-week simple moving average even has flattened down, and 20-week is curling down. 21-week exponential moving average is curling down. So kind of a different reality right now. And again, if you look at some of the volume as well as some of the other indicators, such as for example over here coming back again, although Bitcoin risk has gone to the only 10%, ETH risk is still way up at around 0.22. That means although again the price for ETH is right now lower than the ETH price is lower than the 20-week simple moving average, again almost $700 difference between the current price of ETH, but the price is still above 50-week simple moving average. So that presents a different set of challenges, where BTC risk is low, ETH risk is high. Usually you could see in decent accumulation zones, ETH risk has to be lower than BTC risk. Again, as ETH is more risky than BTC, at any point if BTC cools off more than ETH, it's not a good sign. Especially again, although there was this example where there was a secondary top in November 2021. There was no benefit of hindsight back in June 2021 if the rally would be over. Whereas in June 2022, again, as ETH has had dropped more than BTC in terms of the SMA risk, again, accumulating at that point was not that risky. Again, similar story in August, September, you could make the case that it was essentially slightly lower low on ETH, where 1.159, whereas BTC was 0.16 over there. And similarly in April 2025, ETH was only 5% risk, whereas BTC was at around 8 to 9% at the bottom. Right now, what hasn't happened is, although BTC risk is less than 10%, around 10%, ETH risk is still above 20%. So that's the difference between the current drop and the previous drops. That again, and also coming back to the 4-year market cycle theory, there is very little time left before the conclusion of the post-halving year. By post-halving year, I mean years such as 2025, 2021, where if you go back to the ROI analysis over here, all years are not the same. There is some seasonality in the asset class. Again, for example, if you go year by year, 2018 being a bear market year, let's start with that. Down from the yearly open, Bitcoin was down almost 70%. In 2019, again, it was the recovery year, up 88% from the yearly open. 2020, again, the halving year, up almost 300% from the yearly open. 2021, the post-halving year, up almost 57% from the yearly open. In 2022, again, 4 years later from 2018, there was another bear market where Bitcoin was down 65% from the yearly open. 2023, similar to 2019, again, recovery. 2020, similar to 2024, the halving year rally. 2025, again, not so similar to 2021, but still you could see that there are some similarities where the price still is up from the yearly open, up almost 8% from the yearly open. One could argue that as the asset class matures, the volatility to the upside is capped, and so is the volatility to the downside. So 2026 being in the category of 2018 and 2022, if you take a rough estimate of what 2026 could have in mind, again, it all depends on how 2025 closes. If 2025 is already closing negative or only up slightly, like it is right now, Bitcoin is only up 8% from the yearly open. 2026 could look slightly better than these 2 years, but nonetheless, if I were to if I were to kind of look at historical 4-year market cycle theory based and ROI based analysis, there is higher chance that 2026 would be a negative ROI for BTC than positive ROI for BTC. So with that in mind, again, the magnitude would be much less severe unless we get into a deep recession. And even in that case, again, if 2025 Bitcoin closes somewhere, let's say 70K or 80K, having a 80% drop from that point does not make any sense. Again, 10K BTC, even in the depths of the recession, would be unrealistic, given how many months and weeks Bitcoin has spent above 100K. So let's and again, just as an exercise, not financial advice, let's assume that BTC drops 40% in 2026. That means in 2025, coming back to the analysis of the SMA based analysis, if there is one rally in 2025 back to the 20-week simple moving average before let's say the rally quits, like it did in 2022. So for example, over here in 2022 as well, although the peak for Bitcoin came in November 2021, the price did try to make a rally back to the 20-week simple moving average in the bear market, like it usually does For example, the bear market, one could say that started in again, the bear market usually does start in the post halving year. If you look at the drop for Bitcoin in from early November 2021 till end of December 2021, it dropped from 69k all the way to about 52k. So there was a drop of almost 30% over there. But what is key to see that during the end of the year, the price did go back to the 20-week simple moving average. And if we go back slightly in 2017, that means again the peak for Bitcoin came in December, early December 2017. But still, again, the drop from that peak till the end of year of 20, again end of year of 2017 over here was a bit severe. If you look at the weekly close for this week, or the price did go to 13k from the peak of about 19k. So in terms of percentage, that's about 30% or more. Again, a 6k, if it was 14k, it would have been 30% exactly. In previous cycles as well, then that at that point, Bitcoin was not that famous of an entity, so doesn't make that much of a sense. But you could see that the peak occurred in November 2020 2013. That was 4 years prior to this cycle. So you could see, and after that peak, there is usually a drop comparable, but nonetheless, there is a rally back to the 20-week simple moving average. That is something that remains to be seen if it occurs in 2025 as well. If that occurs, the price of Bitcoin can go somewhere between 110k to 113k. Almost all depends on how the trajectory of the 20-week simple moving average goes. If you were to extrapolate that, somewhere between lower bound would be somewhere between 107k. The upper bound would be somewhere between 107k to 110k. So that's another possibility of Bitcoin's lower high-based peak, kind of concluding that bull run. And from that 110k, then we go to the ROI in 2026, where the price, if it were to drop 40% from 110k, that would be somewhere between 45k to 50k lower than 110k. That could take the price action close to 65k or something. With that, I would like to conclude the video. Hope you enjoyed the content. So that's one bear case prediction for and remainder of 2025 analysis for both Bitcoin and ETH. Nonetheless, again, the market in terms of narrative is still geared towards Bitcoin and Bitcoin related narratives, and the shutdown being over, the slice of bullish narratives is still more than the bearish narratives. But if you go and analyze the number of news article, again, this is available on the last chart, that the bullish bearish chart was under this narrative cloud indicator available, looks at the last 7 days worth of social media narratives related to crypto on YouTube and X, and tries to come up with the term frequency based analysis of which narratives are garnering attention at this point in one holistic picture. Then the second one that we just saw was the crypto TLDR, last 24 hours worth of crypto related news. How many are bearish, how many are bullish? You can see the red ones are the ones which are bearish in nature. You can hover over them to check the news articles in the last 24 hours. What are they saying? The overall sentiment score is, although is still bullish, but still you can see the size and the frequency of bearish narratives has increased over the last 24 hours, which is not a good sign. And other indicators that we haven't discussed thus far are the overall bull market completion, kind of, which is again right now not in scope of the current discussion. With that, I would like to conclude. Hope you enjoyed the content. If you did, please give a like and subscribe, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.